Standard 12, income taxes. Income taxes. Okay, so what is an income tax? I mean, I'm sure all of us are familiar with income tax. So when we
Yeah,
income tax, what comes to mind?
a tax on our income, the income that we earn monthly.
Okay, yeah, it's a tax is charged on income end. Okay, okay, all right. So what else?
Also tax on businesses, on
Okay,
people who operate businesses.
yeah, we have tax on business income. Okay, okay, all right. And then yeah, so we have tax on income end. We have tax on business income. We have tax on investment income, right? When you make an investment, the tax on your earnings, okay, is also a form of tax. For instance, there's 10% tax on betting. Betting is a form of investment, so that 10% tax on the betting that people are, I mean, against it, okay, is also a form of tax. So, and tax is usually backed by law, or it has a legal implication, or there's a legal framework that governs tax or taxation. Okay, so there's a legal support. Okay, and um, failure to pay tax can lead to what? What failure to pay tax can lead to um, penalties, and also what else? Penalties. You can even pay fines, or you pay even imprisonment. Okay, failure to pay tax, tax evasion, or tax avoidance can lead to these consequences. All right, so tax is a mechanism that various governments use to raise revenue for governmental projects or to run the government. All right, the government doesn't have, let me in quote, doesn't have business. Okay, it is a tax that they collect from the citizens, or that they use to develop the country. And tax is what's paid by individuals. Okay, we all pay tax. Individuals pay tax. Businesses also pay tax. They get it. So individuals, we pay tax in the form of PAYE. If you're a salary worker, before your net salary will hit account, you will have paid the tax on it. They will deduct the tax on it and give you the net. Businesses also pay corporate tax. Okay, or yeah, corporate income tax. Yeah, so businesses pay corporate income tax. Okay, and in Ghana, the average tax rate for business tax is 25%. Okay, but it differs depending on a number of factors, such as the industry. The industries have various tax rates that they are given. Okay, so let's say if you are in the hospitality industry, the tax rate is, I think, is lower, a bit lower than this 25%. Okay, and then the location of the business also has an effect. if you're a business, you are located outside Accra, okay, the tax rate you pay is less than a business which is located in Accra. Okay, if you're a business and you are located outside the regional capitals, so you are not located in a regional capital, the tax you pay is also different or is lower than a business that is located in a regional capital. Okay, so we all know that tax is regulated by what law. Is that, do you all agree? And in Ghana, which government institution is in charge of tax? Which or which government institution is in charge of tax administration?
GRA.
Yeah, you correct. So GRA is the one in charge of tax administration. Okay, they are in charge of collecting taxes and ensuring compliance, and also perform tax audits, go around to make sure people are paying their taxes. Okay, so this IAS 12 income taxes, okay, is gives us the principles or the procedure we should follow when we are accounting for taxes. Okay, when a business is accounting for its taxes at the end of the year or at the end of the reporting period. All right. Now we have to keep this in mind. We said that GRA is the administrator of tax in Ghana. Okay, they are the administrator of tax. Okay, so they determine how much tax you have to pay. Is that not so? They, at the end of the day, have the final say. You see, and businesses can determine their own tax, but at the end of the day, GRA has the final say. So you are a business, you can determine the tax you have to pay. That okay, maybe you think in 2023 your tax is 30,000. But at the end of the day, GRA has the final say. They will confirm, decide, agree that okay, this is fine or not. Do you get it? So the issue is that sometimes the way we will determine our tax is different from how GRA will determine the tax. We will say, oh, we are owing 30,000 based on our computation. GRA will say, no, you are owing 45,000. You see, now what should we do with there's a difference of what? 15,000. So this 15,000, how should we account for it? So this principle or this standard talks about or gives us guideline on addressing problems like this, where your business tax is giving you a different amount and GRA will also come and tell you a different amount. So the standard will or gives us guidelines when we are faced with issues like this as to how to account for this difference. Okay, 15,000. All right, so that's all about IAS 12. So you can see it's not difficult. All we are trying to do is we are trying to reconcile GRA tax and our own tax. They get it, and I will try and account. We try and find a way to account for the difference. So that's basically what IAS 12 is about. You can see it's an interesting standard. So what is an income tax? Okay, income tax refers to any tax which is payable on an entity's profits. Okay, we know we pay tax on profits. It's a tax payable on an entity's profits. Okay, so we have two types of, in for the purpose of accounting, we have two types of taxes. We have current tax and deferred tax. Okay, we have what? Current. Current tax is a tax we have to pay now. Okay, we have current tax and deferred tax. Current tax is we have to pay the tax now. Deferred tax is we have to pay the tax in the future. We are not paying it now. It's like you are storing something for the future. Okay, so for the purpose of tax, we have current tax and deferred tax. Alright. So IAS 12 defines current tax as the amount of income taxes payable or recoverable in respect of the taxable profit or loss for the period. Okay. Payable has to do with profits. Recoverable has to do with what? Loss. Okay, when you make a profit, in tax law, when a company makes a profit, they will pay tax on it. If you make profits, you will pay tax. If you make a loss, okay, you will be given a tax credit. Do you get it? And this is a form of assets. Okay, it's a form of. Can you explain why it is an asset? Can someone explain why a loss will give you a tax credit and why it is an asset? Can anyone try? Yeah. Okay. So when you make a profit for a year, it means yeah you have earned more than your expenses. So the difference is your profit. You have to pay tax on it. But when you make a loss, it means that your expenses for the year was more than your income for the year. Okay, it's like you have spent more than what you earned. So that's why you are getting a loss. Okay, you are getting a loss. So for this reason, GRA will give you a credit for spending in excess, okay, of your income. Okay, so that credit will be used to reduce the tax you have to pay in the future. So let's look at an example. In 2022, a company made a loss of 20,000 cedis. It's a loss. The company, which means the company expenses was more than the income they earned. That's why they made a loss. Let's come to 2023. The company made a profit. Here they made a profit of maybe 50,000. Okay. Now once they've made a profit, they have to pay tax on the profit, isn't it? They have to pay tax on it. But the question is that what about the previous year where they made uh they made a loss, where their expenses was more than their revenue? What should we do with this? Okay, so this loss that they made, okay, it will be brought to the next year, okay, to reduce the tax they have to pay. So this 20,000, which is a loss, will be brought here, okay, so that at the end of the day they will pay tax on the 30,000. So instead of paying tax on this 50,000, they will pay tax on only what 30,000. Okay, this is called a tax credit. Do you get it? So a tax credit is let's say it's a form of incentive, okay, given to reduce your tax liability. Okay, and losses is a form of when you declare a loss, you get a tax credit. So that is why GRA, they are always peculiar about companies who declare losses. So if you continuously declare losses, GRA will suspect you. They will suspect that maybe you are doing something wrong. So they may come and audit you. See, because when you are declaring losses, one, you are not paying tax. One, you are not paying. Two, that losses is going to be used to reduce the tax you have to pay in the future. So it's like GRA is losing. It's like a double loss to GRA. Do you get it? First, you are not paying tax because you made a loss. Second, that loss will also be used as a credit to reduce the tax you have to pay in the future. So they are very serious on losses. So if a company keeps on reporting losses, GI will send their audit team to come and check your record to see what's going on. Why you are always reporting losses. Do you get it? Yeah. So that is it. We pay tax on our profits, and then if there's a loss, we get a credit for it. Okay, and tax is an expense. Okay, tax is a form of expense, right? So in the income statement, tax is treated as an expense. So a typical income statement, you see something like this. Maybe you see sales, you see cost of sales, you see cost of sale, you see gross profits like this. You see admin expenses, maybe other expenses. You see profit before tax. Then you maybe it will be here. Then tax will be here. Then profit after tax. Okay, that one will also be. So this is what we are looking at, and this is an expense in the financial statement, right? It is an expense in our financial statement. Okay, so any current tax that remains unpaid. Okay, let's continue. Any current tax that remains unpaid at the end of the period shall be recognized as liability. If you declare a tax payable, let's say this year we have to pay tax of 2,000, okay, and we have not paid it yet, it will be a liability in our books, in our balance sheet. It has to be shown as a liability. Okay, so any tax that is not paid is a liability for us to settle. Do you get it? So you can see that tax is not difficult. Okay. All right. Now, sometimes we pay tax in advance. Even GRA has self-assessments. Okay, where at the beginning of the year you determine how much tax you have to pay, and every year, every quarter, you'll be paying in an installment. Maybe in 2023, you determine that your tax liability is 10,000 for the whole year. So you divide it by 4. This 10,000 divided by 4. So it means every quarter you pay how much? Uh, what's the name? Every quarter you pay 20. Is it 2,000 or 2,500? Yeah. So every quarter you pay like this.
2,500.
Yeah, good. You see. So wait to the end of the year before you pay your tax, but you'll be paying your tax bit by bit. So at the end of the day, at the end of the year, then you determine your actual tax. So your actual tax can be more or less, can be more than what you've paid, or it can be less than what you've paid. So if what you have paid is more than your actual tax, if what you paid is more than your actual, then it means you have overpaid tax, and that difference will be a form of an asset to you. Okay, it will be a form of credit. Usually GIA will not refund the money to you. Ideally they should refund, but since you are still in business, they will say they are carrying it forward to the next year. All right. So when you pay more than your actual tax, but if you pay less than the difference, if you pay less than the actual, it means you have a liability to settle, and that the liability is the difference. Okay. All right. So if the amount already paid exceeds the amount due, the excess should be recognized as an asset. Okay. Now, current tax should be measured using tax rates and tax laws. You see, like I said, taxes are governed by laws. We don't use you don't use your own. Every company and their accounting policies and all that. But when it comes to tax, there's a law we all use. Okay, so when you are computing the tax for your business or company, you have to use the income tax laws. Okay, the income tax act and the rest to determine the tax you have to pay. All right, let's continue. So, like I said, there's a way GRA determines your tax, and there's a way you also determine your tax. Okay, so how does GRA determine the tax? How does GRA determine tax you have to pay? So let's look at something here. Let's say that this is um your financial statement. At the end of the year, you have to file your financial statement with GRA. So maybe your sales was 20,000. Cost of sales maybe was 10,000. Your gross profits. Your gross profit is 10,000. Okay. Maybe your general and selling admin expenses. Maybe 2,000. Uh, let's say depreciation for the year, maybe 4,000. Maybe you pay the penalty because you delayed in filing your tax return, so you paid a penalty. When you fail to file your tax return on time, you pay a penalty of 500 cedis. So maybe this company failed to file their tax return on 2 occasions. So that will give us 1,000 because each occasion is 500 cedis. So 500. If you fail to file your tax return on time, you will pay a penalty of 500 cedis. So we didn't file our tax return on time, so we are paying 1,000. So now we have our profits before tax. So how much is our profit before tax? So we have 10,000 minus 2,000 minus 4,000 minus 1,000. Okay, so we'll get 3,000 here. So these ones are all in brackets. These are expenses. Okay, then tax. Our tax is 25%. So 25% of 3,000 is what? 750. So our profit after tax is 2250. Okay, so this is our profit after tax. So we are telling GRA that we are owing 750. That's the tax we have to pay. But do you think GRA will accept it like that? Or you don't think so? Hello, what do you think? Well,
They won't
GRA,
accept it.
yes, they also have their way of checking whether what you have calculated is correct or not. You see, so they will not accept it. Okay, there's a way they also do their things. So you report this to GRA. Now let's see how GRA will also look at or how they will evaluate it. Now the issue is that GRA has a way of calculating taxable or your tax liability. Okay. Now there are certain rules they use. Okay. One of the rules is what this allowable expenses. Okay, this allowable expenses. Okay, there are some expenses that they don't allow. Okay, in our accounting profits, maybe we can include them, but GRA they don't allow certain expenses. So what are these expenses? One of them is what? Depreciation. They don't allow depreciation. They rather use what you call capital allowance. Instead of depreciation, they use capital allowance. Okay. So this 4,000 that we have put here, they will cancel it. They will say it's not true. Another thing they will not allow is uh, paying fines, penalties, and the rest. Any payment because of breach of law, any payment you make because you have violated a tax law or any law, maybe a tax law, environmental law, any law, labor law, whatever law that you violate, and you are made to pay a penalty or fine or whatever it is, they will not allow it. See, they for this they feel that you were stubborn, you didn't follow the laws, and you incur that expense, so they don't care. They will not allow it. Okay. So for the sake of this illustration, let's let's assume that these are the two items that GRA will not allow. Okay. So if they are not allowed, um it means that, so you can see that it's the expenses that reduces our profit before tax, and eventually our tax. You see, if you remove this 4,000 out, if you take this 4,000 out, this figure will increase, and therefore this tax will also increase. So if GRA doesn't allow this, it means at the end of the day our profit is going to increase. If GRA doesn't allow this, it means our tax is going to increase. You see, so that's how it is. So anything that GRA doesn't allow, it means that at the end of the day, it's going to increase our tax we have to pay. So when GRA is doing the computation, they don't start from here. They start from the bottom here, and then they go to the top. See, they start from here and Sorry, they don't start from here. They start from your profit before tax here, not here. This one is after you have deducted your tax. It is this tax, it is this amount that they don't agree with. Okay, so therefore, and this amount is also based on this. So they start the adjustment from here. Okay, and then they move to the top. So they start from so let me say GRA assessment. So they start from profit before tax. Okay, so in our case is 3,000. Okay, then they will add back. Okay, when you say add back, they are going to add back all disallowable expenses. Any expense that you have included here, which is not allowed, alright, which is not allowed, they are going to what? Add it back. Okay, so one of them, in our example, one of them is depreciation. GRA will not accept depreciation. So we'll add this back like this. Then they will also not accept the penalty. The penalty that we paid, they will not accept it. So they will add this back here, which is 1,000. Okay. So at the end of the day, it's 3,000 plus 4,000 plus 1,000, which will give you 8,000. So this will be your chargeable income. Then so it is this amount that they are going to tax.
The slide is standstill.
Oh, it's not moving.
It's not moving at my side.
Oh, are you all facing the same situation?
No, I think it's going on well. It's okay.
Okay, Michael, is it working? Just still stand still.
It's still standstill.
Okay, then okay, try and reconnect and let's see.
Okay.
Uh, all right, hello.
Hello, I can see now.
Okay, good. So GRA is going to compute tax based on this. So 25% multiplied by 8,000 is how much? So
It's 2,000. It's 2,000.
okay, so you get 2,000. Okay, good, good, good. Okay, so GRA will tell you that this is the tax you have to pay. Okay, but we said we are paying 750. So can you see the difference? 2,000 GRA 750 what? The business. You see, so you can see there's a difference. Alright. So there's a way GRA determines their tax and there's a way businesses also account for their tax, right? Yeah. So that's the point I want to make. Alright. So let's continue. Okay. All right. So that is it. Yes. So let's look at something here. Let's see. Let's look at um. Let's look at overestimates or underestimates of tax from the previous year. Okay. Overestimates. Overestimates. Okay. Let's start with overestimates of tax. Okay. So in the example that we did, what we did was what underestimates. Okay, because this is what we estimated. GRA said we should pay 3,000. So this is underestimates. Okay, so I think let's start with underestimates since we just did underestimates. Okay, so if there's an estimate of tax, okay, what happens? All right, so let's say that this was 2022. Okay, this tax that we determined was 2022. So 2022, we determined that 2022 we determined that our tax liability was how much? Was it 750? 750. Okay, 750. So when so this is the tax liability that we determine. So what is the double entry? How do we input it in our accounting system? So what we do is that we will debit tax expense 750. Then we will credit tax liability of 750. So that's it. Now let's say that now we can see GRA came and said we should pay 3,000. Usually, usually the payment is at the end of after the reporting date. Okay, because this 750, let's assume that we estimated it at the end of 2022, and GRA told us that we should have paid 2,000. So the 2,000 we paid in 2023. That was the following year. So what is the double entry for the payments? Okay, who can help us with the double entry for the payments? Okay, GRA said we should pay 2,000. So what's the double entry for the payments? Anyone to help us? So the double entry for the payment is that. So now we are paying with cash or we are paying at bank. Okay, so that means we have to credit our bank. Is that not so? We have to credit our bank by how much? Because we paid 3,000. GRA said we should pay 3,000. So we have to credit our bank
With a difference.
of 2,000. So this is the amount we paid. Now we have to debit our tax liability. Now remember, the tax liability, we made only a provision of 750. So the maximum amount we can debit is 750. Do you get it? So now what happens to the difference? The difference is how much?
1,000.
Hey, wait, oh, is it 1,000?
1,250.
Well,
Okay, 1,250. Yes. So this 1,250 is like an extra expense. So this will go to our tax expense. Do you get it? So look at something. At the end of
my
2022,
is your screen moving? I think I still over S. I can see the slide. Oh, the slide. I don't know whether you are doing any calculation.
yeah, I'm doing calculation. You can only see the slides.
Yes.
Please,
So let me.
are we all seeing the slides or the screen? Hey,
No, I can see the screen. I can see the calculation.
you can see the calculation. Okay. Oh, then Mike, today your network is disturbing you. Hello.
Yeah, Max, I'm here.
Okay, can you see the calculation now?
Yeah, I can see now.
Okay, good.
I can see now.
All right. So yeah, good. So let's go over what we were doing again. So let me. So in 2022, at the end of the year, we estimated that we are going to pay. We estimated that we are going to pay 750. All right. So we will debit our tax expense. You know, tax is an expense. So we debit tax expense. We will credit our tax liability. Okay, fine. Then GRS said we should pay 2,000. So we have to pay 2,000. And we have to pay with cash or bank. So we have to credit our bank. You know, bank is an asset. So assets, whenever you are making payments, you credit it. You get it. Assets, we credit it when there's payment. So we credit our assets like that. Then we have to debit our tax liability. You know, our tax liability, the amount that we accrued was 750, or the expense that we recognized was 750. Yeah, so it is here. But you know, double entry, everything must be the same. This and this must be the same. So there's a difference of 1,250. So it means this is additional expense. Okay, this 1,250 is additional expense we have to recognize. Okay, so it will go to our tax expense. So what this is saying is that whenever there's a underestimate of tax, we have to recognize additional tax expense. Okay, whenever there's underestimate of tax, we have to recognize what additional tax expense. So we have to recognize additional tax expense whenever there's a what's the name? Whenever there's a underestimate. Okay. So what do you think? Whenever there's overestimate, what do you think we can do? If underestimate means we are recognizing additional expense, then overestimate, what do you think we have to do? Can somebody try? If there's
Additional profit.
yeah, so if there's overestimate, yeah, it will be additional, let me say, it will be a gain, you know, it will be a gain, or it's not profit, but it's a form of gain.
Income or
Yeah,
gain.
yeah, something like an asset for us. So for instance, we were hoping to pay tax of 2,000. So we paid the 3,000. GRA said we should have paid, or we should have paid 1,500. Or okay, let me say we made provision of 3,000, so that's the tax we we were expecting to pay. But GRA said we should pay 1,500, and we paid 1,500. So it means this is an overestimation. Yes, but let's look at the double entry. So debit, credit. So initially we estimated that we are going to pay tax of 2,000. So we'll do our tax expense of 2,000 here. So that's what we're thinking we are going to pay. And then our tax liability of 2,000 here. But GRS said we should have paid 1,500. So we paid 1,500. Okay, so this is the initial. This one is the initial recognition. This one is the payment. Okay, so we paid 1,500. So when you pay, you have to credit your bank 1,500. Okay, and you have to debit your what? Your liability. But our liability is more than what we can debit. So we will limit it up to what? Sorry. Let me see. Uh, let me see something. Our tax liability is going to be okay 2,000. Okay, fine. That's 2,000. Yeah, because this is the amount that we recognize. So we debit it by 2,000. But there's a difference of 500. Okay, so that will go to our tax expense, which will be what 500. Now notice that this is at the credit side. Okay, so it means this is a form of gain. Do you get it? This is at the credit side, so it means it's a form of what gain for us. So whenever there's overestimate of tax, we recognize a gain. Okay, a gain of of the of the difference. Do you get it? Yeah. So this concept is very crucial in the examination. Usually, the examiner will try to examine on these concepts: overestimate and underestimate. Now let's come to deferred tax. Okay. Okay, what have you heard of deferred tax? Has anyone heard of deferred tax?
A tax that you have to pay in the following year
Okay, good.
or later.
Yeah, a tax that you have to pay in the future, or you have to settle in the future. Yeah, that's deferred tax. But the question is, what causes that? What causes a situation where we have to pay the tax now? Because I thought taxes we have to pay now. So why are we going to pay the tax in the future? Yeah, that's the question. So what do you think? What will make us defer?
Maybe you run to losses and you are not able to pay the taxes.
Okay, okay. So when you yeah when you record a loss, yeah, okay, yeah. I think you are close. Let's say you are close. Actually, when you make a loss, you will not pay tax at all. Okay. Yeah, deferred tax. Let me give an example. Example. Let's say that you have made some sales. You have made some credit sales of 50,000. Okay. You have made sales. You know, sales will bring you income. The customer will have to pay. Okay. You made the sales in 2022. At the end of 2022. Okay. The customer has to pay you. Okay. And you know that sales is income. That means you make profits on this. Whenever there's a sale, there's profits. I mean, usually there's profits, but sometimes there's a loss. But assume that there's a profit we will get from the sale. Okay, but the customer has not paid. As as at the end of 2022, the customer has not what paid. As at 31st December 2022, the customer has not paid. So if the customer has not paid, it means that uh, we have not received the money. It means that we have not also, even though in our accounting system we record sales, receivable, and all that, but actually the customer has not paid. So it means we cannot pay tax on this sale. Is that not so? If there's a tax on this sale, let's say we have to pay tax on this profit, the profit in this sale, we cannot pay it because the customer has not paid. Do you get it? So we are waiting for the customer to pay us before we can also pay GRA. Do you get it? So this can lead to deferred tax. So even though we have made the sale of 50,000, GRA cannot come and tell us we should pay the tax on it. Where are we going to get the money from? The customer has not paid us, so how can we pay? You see, so this can lead to what? Deferred tax. So it means that we are, as soon as the customer pays, then it means we have a liability to settle. We have a tax liability to settle. But as long as the customer has not paid, it is still it will be a deferred tax liability for us. I hope you get the concept. Do you get the idea? Or it's confusing?
Yes, yes, sir.
You get it right. Yeah. So if the customer has not paid us, we cannot pay GRA, but it will be something that will be standing there. Okay, so we are deferring it until the customer makes payments. Okay, so that's what brings about deferred tax. Okay, so these are one of the reasons for deferred tax. Okay, yeah, deferred tax. And deferred tax, we can have a deferred tax liability or deferred tax assets. Okay, we can have a deferred tax liability. So there are two types of deferred tax. We have deferred tax liability and we have deferred tax assets. Okay, so I've explained the deferred tax liability where an example is we have made credit sale, the customer has not paid us, so we cannot uh, we, we cannot pay GRA. Okay, what about deferred tax assets? Okay, deferred tax asset is, I'm trying to give an example. Let me say that, so assets, for assets is not like you are owing. You see, here it's a form of benefit that you are going to get. Liability means is a something that you have to settle. Asset is a form of benefit. So let me look for an example. Let me see. Um, I'm trying to get an example. Okay, let's say that. Okay, let's look at an example. Hey, this is 1,000. Let's say that, okay, this is a simple example. Let's say you've made sales of 3,000, and this is salary expenses. You have to pay some salary expenses of 1,000. So at the end of the day, this is your profit of 1,000. 3,000 minus 1,000 is will give you 1,000. So you have to pay tax on this amount. Okay, you have to pay tax on the 1,000. Now, assuming that you have not paid these salaries, you have not paid, you are a company, you've not been able to pay this salary, you've not paid your workers yet, but you know you have to pay them this 1,000. But GRA can say that since you have not paid this, since you have not paid the 1,000, we will not recognize this. We will still let you pay tax on the 2,000. Okay. Just will say that fine, you have recorded that you pay salaries of 1,000, but you have not paid, so we can't deduct it to reduce your tax. So we will still use the 2,000. Okay. So they will tell you that okay, when you pay, then we'll use it to reduce your tax liability. Okay. So in the current period, you will calculate tax on the 2,000. But maybe the following year, if you pay the salaries, the GI will give you a credit, okay, for the salaries that you have paid. They will give you a tax credit for it. Okay, so that leads to what deferred tax assets. Okay, so it is an expense um that uh, that even though it is an expense, all right, but GI does not recognize it at the moment. Okay, because of certain reasons, they don't recognize it at the moment, but they recognize it in the future. So that's what will lead to what deferred tax assets. All right, so that's a typical example of deferred tax. So deferred tax asset also arises when you have an expense, but GRA will not allow it because of some reasons, but they will allow it in the future. Okay, so that's it. Okay, so now we know deferred tax um, deferred tax assets and deferred tax liabilities. Now let's look at the causes of deferred tax. Okay. Deferred tax is caused by two things. According to the standard, deferred tax is caused by permanent difference and temporary difference. Deferred tax is caused by two issues. One is what? Permanent difference. The other one is what? Temporary difference. Okay, so permanent difference and taxable difference. Alright, okay. Actually, this is not the cause of deferred tax, but this. Alright, I think I need to take it again. Let's look at accounting profits. Okay, we have accounting profits and taxable profits. Okay, we have accounting profits and taxable profits. Accounting profit is determined by our accounting principles. Okay. Taxable profit is determined by GRA. Okay, GRA will determine your taxable profit. Then our accounting principle will determine our accounting profits. Now, ideally, they should be the same, but that's not the case. They are not the same. Usually, there's a difference between the accounting profits and taxable profits. So right now, the question is, what accounts for the difference? What causes the difference? What causes? So the difference is caused by two things. One is temporary difference. The other one is called what? Permanent difference. Do you get it? We have temporary difference and permanent difference. These are the causes of these causes the accounting profit to be different from the taxable profit. So what is temporary difference? So that's what we are looking at. So temporary. So we all know what temporary is. What is temporary? The word temporary means what? Anyone? The English professors. Please, can you tell us what temporary is?
Something that is not static.
So, can you come again?
Something that is not static.
Okay, something that is not static. Okay. All right. Any
Oh,
other?
it is subject to change within a short time.
Yeah, it is subject to change within a short time. Yeah, something that is temporary means yeah subject to change or just for a short period, and its effect will no longer be felt. Okay, that is what temporary difference. Temporary difference. Something that its effect will not stay for long. It's just for a short time, and then we'll go back to normal. You get it? Like maybe like someone who is intoxicated, who has taken in alcohol. For some period, the person will feel high and good and misbehave and all that. But after some time, the effect will go away and he will come back. you will come back to the senses. So that's so all the period that the person was high and misbehaving and all that, it just for a period. After that, it will become normal again. Okay, so that's temporary. You get it. Yeah. So we have a concept called temporary difference in IAS 12. So temporary difference causes accounting profit to be different from taxable profits. Okay, and what is or what brings about temporary difference? Okay, what brings about temporary difference? Okay, the the main thing that brings about temporary difference is depreciation. Okay, depreciation and capital allowance. You see, this is what usually brings about temporary difference. Depreciation and capital allowance. You know, depreciation is well is a periodic allocation of the cost of an asset over its useful life. It's a periodic allocation of the cost of assets over its useful life. So if you buy maybe a car for 50,000 and the useful life is 5 years, it means every year we are allocating how much? 10,000. We are allocating 10,000 towards profit or loss as an expense. So capital allowance. Capital allowance is also the same as, or the concept is the same as depreciation. It is also an allocation of the capital, is allocation of a capital expenditure, or it's allocation of the cost of an asset over its useful life. But the main difference is that the main difference is that the base that is used to calculate capital allowance and depreciation may be different. Okay, so the company will use, let's say, 5 years, but GRA may use maybe 6 years. Do you get it? The company may use what? 5 years, but GRA may use what? 6 years. So 6 years, how much are we getting? 50,000 divided by 6 will be how much? So we are getting 8, 3, 3, 3. Is that not so? So let's look at something. We have depreciation here, capital allowance. So year 1, depreciation 10,000. Hello, can you hear me?
Yes, we can hear you.
Capital allowance 833. Year 2, depreciation 10,000. Capital allowance 8333. Year 3, depreciation 10,000. Capital allowance 8333. Year 4, depreciation 10,000. Capital allowance 8333. Year 5, depreciation 10,000. Capital allowance 8333. Now we are done with the depreciation because 5 years. We are doing it to 5 years. So here we will get how much? 50,000. But capital allowance, we are not done. We are left with last one. Okay. So 1, 2, 3, 4, 5, 6. So now let's look at the differences. So the difference between this and this is how much? So this minus 10,000. So that's 166. Let me see 7. Okay, this is also 1667. 1667. 1667. 1667. 1, 2, 3, 4, 5. Now this one, the difference is what? 8, 3, 3, 3. Okay. So this minus this will give you this, but this one will be in back because it's this minus this. Okay. So at the end of the day, when you add all the differences, you should get 0. Okay, you can try it and see. The differences between them at the end of the day will be what? 0. You get it. This plus this plus this plus this plus this plus this will give you 0. Okay, so it means that's why it's called temporal. It's a temporal difference because at the end of the day, the differences will be 0. It will cancel out. Do you get it? And so the differences are just temporary. I hope you get the idea.
Yes.
Yeah. So even though you can see the differences every year, there's a difference, but at the end of the day, the differences will cancel and we'll get to 0. Okay? That's what causes temporary difference. And temporary difference can lead to deferred tax liability, okay, or assets. So let's look at an example. Okay, a company with an issued share capital of 1 million ordinary share has the following results for the for the 3 years to 31st December 2018. Profit before tax 800, 800, 800. Depreciation charge in the year 200, 200, 200. Depreciation for tax purposes 400, 150, 50. Assuming that there are no other permanent or temporal differences and that the rate of tax is 20% throughout, compute the company's profits after tax for each of the 3 years. Okay. Assuming that there are no other permanent or temporal difference and that the rate of tax is 20% throughout, compute the company's profits after tax for each of the 3 years. Okay, so let's see how we calculate our profits after tax. Okay, so we are supposed to calculate the profit after tax. So the question is, so we need to know this is what this is profit before tax, and this is what depreciation charge in the year, and this is what depreciation for tax purposes. So this is the capital allowance I'm talking about. Depreciation for tax purposes is the capital allowance I'm talking about. Okay, so and this is what we use to determine the tax we have to pay. This is what GRA will use. They are not going to use this. Okay, they are not going to use this to determine the tax you have to pay. So let's see. So we have 2016, 2017, 2018, 2017, 2018. Our profits before tax. Our profit before tax is 800, 800. All the years are 800. Okay, so right now we are calculating the profits after tax. Okay, based on GRE, we are calculating the actual tax. Okay, using GRE's standard. Okay, so if we are calculating our actual profit after tax using GRE, then it means we are not going to we are going to add back the depreciation because GRE does not allow depreciation. Okay, so we have to add this back. Remember the example that we did. Okay, so add back depreciation. Okay, so 200, 200, 200. So 200, 200, 200. So we are getting how much? 1000, 1000, 1000. Then we will left our capital allowance because GRA will allow capital allowance. So 400, 150, 50. So 400, 150, 50. So our profit, our chargeable income. Yeah, this is the chargeable income. Or chargeable income means income that we pay tax on. So this will be what 600. This will be what 850. This is what 950. So this is the tax. This is the amount we pay tax on. Then the tax. They say the tax rate is 20%. So 20%. So 20% multiplied by 600 will give you how much? So this was 120. This 170. This is 190. So those are tax we have to pay. Okay. So our profit after tax. 600 minus 120. 480. 850 minus 170. 680. 950 minus 190. 760. Okay, so these are our profit after tax. Okay, 480. Okay, so this is the actual tax GRA will tell us to pay. Okay, this is the actual tax GRA will tell us to pay. So at the end of the day, what's the total tax we pay for the 3 years? Can you add it for me? Hello, are we there?
Yeah, yeah. You're
Okay,
adding, but
okay, all right. So kindly add for me.
1,920.
1920. Yeah. So for the 3 years, This is the tax we will pay. GRA will tell us to pay. Okay, so this is based on GRA's formats. Okay, now let's determine how much we will also pay using accounting approach. This is based on GRA's calculation. Okay, now let's look at how accounting will.
No, no, no. Mark, go back.
Okay,
The tax 20%, right?
yeah, 20%, yeah.
Yeah, it's wrong. Wait, please, it's wrong. It's
Okay,
it's 480.
yeah, it's 480, yeah, it's true.
120 plus 170 plus 190.
Yeah, correct, 480. So at the end of the day, we are paying 180 for the 3 years. So this is based on GRA assessment. Now let's come to accounting assessment. So the same 2016, 2017, 2018. Okay, so we have profit before tax is 800, 800. It's the same for all the 3 years.
Yeah.
Yeah, 800, 800, 800. Now, for our accounting purposes, we use depreciation. We use the depreciation. And this depreciation has already been factored in this to arrive at this 800. Okay, so we don't need to use it again. Okay, now we are applying the accounting principles, or we are using the accounting perspective. So from here, we just apply our tax. Okay, like profit before tax, and then we come to tax. Okay, so how much are we getting? For 2016, 20% of 800 will give us how much?
I'm coming on.
Okay, so this is 160.
160.
Okay, so everything will be 160 throughout.
Yes.
Okay. So 800 minus 160. So 640, 640, 640. So those are profit after tax. Okay, so add all the taxes and let's see how much we are getting.
I'm coming on. My screen is not moving. So let me
Oh,
raise. I'm coming. I
okay,
don't know
all
why
right.
today.
Oh, the screen is
I'm
tired.
coming.
Okay.
Okay, I'm there now.
Okay.
Yeah, you're saying I should add.
Yeah, this plus this plus this.
Okay, that'll be 480.
Yeah, so this,
480.
this is also what 480.
Yes.
So it's the same as what GRA also said we should pay.
Yeah, the same as what Gary said we should pay.
Yeah, but you can see that there are differences. Like, but the
You can.
yearly,
There are differences in the years. The
but
years, the tax are not the same, but with the personal one is the same.
yeah, yeah. So you can see at the end of the day, the total amount is 480 for each.
480.
uh
Yeah.
So it means that the differences between the taxes are temporary. Do you get it? That's why it's called temporal difference.
Yes.
Uh, so 2016, uh, let's say this is GRA and this is accounting.
So
GRA,
the temporary, it changes. The tax changes, but if the permanent is the same. It's run through the same.
yeah, and because the depreciation is the same, you see, that
Yes.
is why. But GRA, they don't, they have their own way of calculating capital allowance. You see, so that's what causes difference. So 2016 GRS said we should pay tax of 120, and then we said we are paying 160. Okay, 2017 GRS said we should pay tax of 170, and we also is also
So
160. 2018 we said GRS said we should pay 190, but we paid 160. Okay, so let's look at the differences. So this minus this is how much?
that will be 40. 40.
Okay, this is 40. This one is how much?
With 10.
Okay, this one is negative 10.
No,
Hey,
this one will be positive.
it's positive. Okay.
Positive.
Okay, then this is
The
negative.
the first one is negative.
This is
2016
negative.
is negative.
Yeah.
2017 is positive.
This is
10.
positive 10, and this is what 30, right?
And the positive 30.
So at the end of the day, they cancel out. This and this and this, they all cancel out. We get everything becomes zero, because negative 40 plus 10 plus 30 will give you.
It will
So
be
that
zero.
is where the deferred account comes in. Okay, that's where the deferred issue comes in. So in 2016, okay, we accounted for 160, but GRA said 120. Okay, so it means that we have a deferred tax liability of 40. Okay, so this is what a deferred tax liability. Okay, so assuming that there's a deferred tax, I'm coming. 2016. Okay, let me just say deferred tax liability account. Okay, deferred tax liability account. Okay, let's look at the account. So 2016. Okay, we were supposed to pay tax of 160. Okay, and GRA said we should pay 120. So it means we are owing 140. Did you get it? So
Yeah.
this is a liability. Okay, so this 40 will go to our deferred tax liability account. We were supposed to
Yeah.
pay 160, but GRA said we should pay what's the name? 120.
120.
So this will go to our deferred tax liability account. Then we come to 2017. GRA said we should pay 170. Okay, but we paid how much? We paid 160.
160.
Okay, so so it means that we paid more than what I mean what we accounted for. Okay, hold on, let me. Here, JF said we were supposed to pay 160. Okay, but we paid 120. Okay, so it means we have 140 to pay. Okay, here we're supposed to pay 160. Okay, but we paid 170. So it means we paid excess. Do you get
Yes.
it? We paid more than what we should have paid. So minus 10. So this would be like a form of credit for us.
Yes.
So this would be credit. Here we're supposed to pay 160, but we paid 190. We paid 30 more than what we should have paid. So we are
Yes.
getting what? 30. So at the end of the day, everything is what? Zero. Uh-huh. So it means that what it means is that the 140 that we didn't pay in 2016, we paid them in the subsequent years.
Yes. Yes.
Do you get it? This 140 that we should have paid that we didn't pay. Okay, we actually settled it in the subsequent years. So that's the concept of what deferred tax liability. Uh-huh. And that is also the concept of what temporary difference. So at the end of the day, we pay the full amount, but it's just that the amount we pay each year will be different from what we accounted for. Do you get it?
Sure.
So
Sure.
that's basically the concept of deferred tax liability. Yeah.
Hey, Patrick and Cody didn't come back.
Hey, I'm sure they are tired. Eh?
Hey, they don't know.
Eh,
Whilst people are going, while people are going for class in the morning and closing at 5 p.m.
no be small. Hmm.
Due to distance, I joined a certain class
Okay,
at Kumasi when I was writing PSC
okay,
last session. When you go in the mornings,
uh-huh.
goes 5 p.m.
Hey, serious.
Classes start at serious. Classes start at 7:30. Then we close at 5.
Wow. See, it's a very, very busy day. Very, very hot day. Hmm.
Yeah.
Yeah, it's true. This year, if you don't put in effort, they will show you.
Mm.
CA is something. Hmm. Hmm. So you have to also strategize and face it.
Sure.
Yeah,
Sure.
and face it well. Yeah. So that's the concept of deferred tax. All right. So so the issue we have to also look for is what causes. If you look at this question, okay, the depreciation charge. If you add them, how much do you get? It's 600, right? 200 times 3 is 600. Yeah, and then the capital allowance is also 600. All right. But the question is why are they different? And they are different because of how GRA calculates their capital allowance and um how we what's the name? How accounting also calculates depreciation. So depreciation has to do with assets. So let's look at an example. Um, we have an asset, a vehicle. The cost is 50,000. Okay. The depreciation is 5 years. So our depreciation is how much? 10,000, right? Our depreciation for the first year is 10,000. So our current amount will be what? 40,000. Okay, so this is accounting. Let's look at tax, GRA. It's the same 50,000. But depreciation is, let's say, 6 years. So 10,000 50,000 over 6 will give us how much? So we are going to get 8333. So the carrying amount is what? 50,000.
Determine 2,000 minus 8,333. That'll be 41667.
Okay, good. So this is the carrying amount of the assets as at the end of the year. That's the carrying amount. This one is called the tax base. Okay, GRA don't call it carrying amount. GRA calls it tax base. Okay, so you can see, and assuming that the company's maybe the company made a sale of in the year, the company's income was maybe 70,000. Okay, and this one too is what, 70,000. Okay, and depreciation here is 10,000. Capital allowance is 8,333. So profit before tax, this is 60,000. Profit or chargeable income is 70,000 minus,
61667.
yeah, 61667. Okay, then we calculate our tax. This is 25%. So 60,000 and 25% is
15,000.
okay. Good. Okay, then the other one 61, 267, 25.
That'll be 15,417.
Yeah.
I rounded it.
Okay, yeah, 417. Okay, good. 15,000. So you can see that even though our income is the same, okay, but the tax is different. See, we are accounting, we are paying tax of 15,000. Here we are paying tax of what? 15,000. Okay. So what this means is that we are supposed to pay tax of 15,000 accounting, but we are actually paid tax of more than that. Okay. So this will lead to what we call deferred tax assets. Okay, because we paid more than we should have paid. So that difference will be like extra money we have paid. Okay. But as we saw in the illustration, at the end of the day, everything will become zero. Okay, so those differences are just for a short period. Okay,
Yeah.
yeah. So this will lead to what? A deferred tax asset, because that's what we were supposed to pay, but we paid more than that. So that difference is what? A deferred tax asset. So deferred tax assets occurs when the tax base, sorry, when the tax base, or okay, when the carrying amount of an asset is less than the tax base. Okay, deferred tax asset occurs when the carrying amount of an asset is less than the tax base. Anytime the carrying amount of an asset is less than the tax base, there is a deferred tax asset. Okay, anytime this amount is more than this, it will lead to deferred tax assets. Okay, assuming that this amount, okay, assuming that this amount was maybe 7,000. No, let's say 5,000 instead of 10,000. Assuming that this amount was 5,000. So our current amount will be what? 45,000. Okay, because 50,000 minus 5 will give us 40,000. So our depreciation will also be what? 5,000 here. So this will be what? 65,000. So our tax will be what? 65,000 times 25%. 5,000 times 25% is what? 16,250. Okay. So now you can see our tax is more than that. So this is the tax we have to pay. Okay, we said we
Yes,
will
sir.
pay, but we actually paid less. Okay, so the difference becomes a liability for us. The difference we
Sure.
didn't pay becomes a liability. Do you get it? So when
Sure.
the current amount, so you can see that this current amount is more than this.
Yes.
This 45,000 is more than this. So whenever the current amount of an asset is more than the tax base, it leads to what? Deferred tax liability.
Ability.
Whenever the current amount of an asset is more than the tax base, is more than its tax base, it leads to what? Deferred tax liability.
Liability.
uh So this concept is very important because it comes in the published account in the notes.
Yeah.
They will throw a question like this, and you
And
have
ask you.
yeah, they will tell you that the company has an asset whose carrying amount is more than the tax base by a certain amount. And so let's look at the difference. 45,000 minus 41. How much is it? What's the difference in
Oh,
the
I'm coming. It's 3,333.
3,300 and like this?
33. Yes.
Yeah. Okay, so apply 25% on this amount. Okay.
On the
How much?
3,000, on the 3,333.
Okay, 3,333 like this. Okay. Okay, apply 25%. This tax, apply it on this. Let's see.
I'm coming on.
Okay.
I'm coming.
So you get 8.
It's 33.25.
Okay, good. Okay, so this amount, okay, is the same as the difference between this and this. Okay, so let's try and find the difference between this tax and this VAT. 16,250 minus 15,417.
I'm coming on.
Okay. 16,250 minus 15.
250 minus 15,417.
Yeah.
It's 833.
Okay. Yeah. So you can see this is the same as this. The same. Mhm. So in essence, they will tell you that the current amount of an asset is of an asset is more than the tax base by a certain amount. Maybe they will tell you that it's more than the tax base by maybe 20,000. So calculate the deferred tax. All you do is you apply the percentage on that difference to get your deferred tax. You see, you can see that when we found the difference between these two, we got this. When we applied the 25%, we were able to get the deferred tax liability. You see, it's the same as working here. So in exams, they will say that a company, okay, a company has an asset, okay, whose carrying amount, whose carrying amount is 20,000 more than the the tax base. Okay, calculate the deferred tax liability. Then they will give you the rate. The tax rate is 25%. Okay, so to calculate the deferred tax liability, you just pick this amount because there's the difference. Is the current amount is higher than the tax base by this amount. So it's just 20,000 multiplied by 25%, and then you get your what, deferred tax liability. Yeah, that's it. Do you get it? Is it difficult? Hello? Hello? Hello?